This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Hey, we'll look at the macro stuff, but it was a pretty dull week for a week that included a Fed meeting. So this week, let's also focus on earnings and the results from a couple of our holdings on this week's Wise Investor Show. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. I don't know how, but somehow if Simon came on here, he'd be talking for at least 45 minutes. But in broader terms, there is just not a ton happening right now. A couple of weeks ago, there was a pile of headlines freaking out the markets, and a lot of that has fallen by the wayside, either by being resolved or proven to be unimpactful. And the markets have trudged along. The month seen a fair share of volatility, but really not as much as I expected as we finished up last year. On the heels of multiple back-to-back strong years in the markets, we expected a bit of rebalancing, but the S&P 500 made new all-time highs this week. It's up now about 1% for the year. And the Dow Jones is also in the green, although it still hasn't crossed that 50,000 barrier. And there was some talk of a broadening rally in the markets with more sectors seeming to participate. But that notion has waxed and waned as the tech sector has certainly still dominated the conversations. Although in the end, it's really the earnings that are mattering. And today, the broadening rally is back in fashion. The equal weight version of the S&P 500, all the companies, same companies, equally divided instead of cap weighted, it's up about 4% for the year. And the big difference right now is not that other sectors are taking off, but largely due to a bit of a sell-off in tech on the heels of earnings reports. And that's good, as it gives me some ammunition for the show. And later on, I'll do a bit of a lightning round and review some recent results. We did have central bank meeting this week, and largely as expected, the Fed didn't change rates. I discussed this small chance for a rate cut, but it didn't happen. And the market didn't have much of a reaction to the meeting, and the S&P 500 was actually dead flat on Wednesday. It really just wasn't a big Fed meeting, not much changed. Powell said that the voting members believe they're, quote, within a plausible range of neutral, end quote. He said that the signs of labor market weakness were less evident in the data, so that would suggest less of a need for future rate cuts. And they also removed the language about a cooling job market from the official statement, while he also said that there's clear improvement in the outlook for growth in the economy. He said that while there's, quote, still tension between the mandates and they believe that policy is in a good place, it's hard to say if they're in balance, end quote. So really, it was a nothing burger of an outcome from this week's meeting. It was really largely about downplaying problems in labor, so potentially no cuts are warranted. The analysts over at Strategist said that their statement, the Fed statement, had some notable upbeat language, and that it's actually, in their mind, a big change that they also dropped the employment risks from that statement. But they also noted that Powell said that most of the excess core inflation was from the tariffs, and that those effects now are fading. And Strategists repeated their comments that they had in December, saying that the FOMC looks set to move from skipping a cut in January, instead not just skipping, but moving on to a longer-term pause in policy moves, meaning no more cuts. Two items that are worth noting this week is first that the consumer confidence report was 84.5, well below the consensus estimate of 91 and the previous reading of 94. And how that translates to spending is worth watching, especially if tariffs do start being reflected more so on the prices on store shelves. But one of the bigger stories now getting more attention this week is the weakening U.S. dollar and the appearance now that the White House is supporting a softer dollar. The combined dollar index is down about 2% this month, and the dollar is down about 12% over the past year, which in currency terms, 12% is a very big move. However, it's a very long way from projecting that this just kind of keeps spiraling into oblivion and will eventually be losing all of our buying power. Strategists' interpretation is that this was part of the White House's broader economic plan and a way to attack our trade deficit, which was also updated this week, and that trade deficit took a huge leap higher. But regardless of the intent, which I'm not so sure is deliberate or an attempt at spin here, but my thoughts are aligned with the strategic report, which points out that the dollar has simply retraced its level basically back to where it was pinned at for many years before the pandemic. If the dollar does start to level off in this vicinity, it basically keeps us in a zone where we were at from 2015 up and through 2019. And before 2015, the dollar was actually much more weaker than that. So right now, it makes your trips to Europe and the purchases of European cars and wine that much more expensive, but it does allow the U.S. goods to be more competitively priced overseas. Now, if we're licensing a bunch of software, we're selling a bunch of microchips and shipping a bunch of soybeans into economies that have stronger currencies, well, that trade balance will reflect the price difference in dollars, and the exporters will therefore see a reward. For the broader markets today, the S&P 500 right now is trading at about 22 times the expected earnings for this year, based upon the consensus that I got off of FactSet. And we're in the middle of earnings season, and I'll dive into that after the break. But based on results so far and the estimates for what remains for the season, the S&P is expected to see about an 8.2% earnings growth rate for the fourth quarter last year. And that consensus is estimating now a 14.7% earnings growth rate for this current year. And at this point, to steal a notion or a point from my friends at Blackstone, it's hard to model much growth in stocks from further valuation expansion right now for this year. We could see some more of that, but it would take us up into pretty lofty territory, seeing us trading at 24, 25 plus times earnings. So at this rate, basically that would model out to see pretty modest returns for the markets, except if results could come in well above that average 15% earnings growth rate. If we track basically on target or slightly above, well, we could expect growth in the mid to high single digits. But, of course, not all stocks and sectors are created equal. Back to the FactSet estimates, they note that using the average target prices on Wall Street, they expect that the biggest gains are still going to come from the technology sector because the 12-month price targets, and this is probably the least valuable notion, but just what they've spin their targets at, are actually 17% higher than where they are today, or I should say yesterday, after some notable tech declines today. But while the analysts have now the lowest hopes are for the energy sector, only forecasting a 6% gain versus from today's levels to their target prices. And therein may lie some value as, well, the price of oil, I guess, is anyone's guess at this point. It is expected that consumption is going to see improvement globally. But while the demand might improve, the supply is subject to radical shifts that are hard to model for. As, of course, Venezuela is a huge wild card, as, of course, is what holds the future for Iran right now. For what it's worth, there is a lot going on regarding Venezuela. So note on the upside that they're low-hanging fruit. The oil that they have that's easily accessible, the stuff that they can actually pump out of the ground, that could actually return to the markets in force in a pretty quick way, faster than most of the headlines would probably have you believe. But the massive investments that are being called for, the expectations that it will take years and years to complete, that's based upon what's more than half of their total reserves. And this gets down to when you talk about Venezuela as being one of the largest reserves in the world, most of that is held in sandy deposits and bitumen, essentially, which you can't just pump out of the ground. It's a lot harder to get out of the ground than pumping it out of the Middle East or West Texas. It is less valuable, therefore, and takes a lot more infrastructure spending that is not in place to be produced today. So we'll see what happens there. Okay, I am going to jump into a short break, but I'll be back in a moment with a look at the earnings from 2 or 3 of the companies that reported this week. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
The unwieldy fire hose of daily news flow is only getting stronger. How do investors separate the noise from what actually matters? Tune in every week as we discuss the latest financial trends and how to filter what's distracting you from investing success. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. We saw a lot of big names deliver their fourth quarter results this week, so let's dive into a few of them. But know that I am choosing ones which I own and we own for our clients in their managed portfolios. So the normal caveats here apply. You know, I'm carrying a positive bias and therefore a conflict of interest. So always buyer beware here. Do your homework. If you're not a client, you're just a listener. Don't just, of course, I don't know why you would. Don't just go out and buy these stocks based on what I say here. But let me start out with Mr. Softy. And, you know, we really don't hear that much anymore. But that's what we called Microsoft back in the 90s. And it's not that their business has changed. They still dominate the operating systems of so many business systems and personal computers these days. But they've broadened their focus and their sources of revenue over the decades. And the cloud business and now the AI business is what really drives revenue growth. And if not quite there, it's getting close on the cloud stuff, taking up the top position as far as largest current revenue source. Microsoft is the fourth biggest company in the world. So it's something to see when you turn on the computer and they announce results and the value of the company drops by over $350 billion in one day. They lost over 10% of their value on Thursday. And a drop like that, you'd think that they announced that their products cause cancer or something. But it really is not even close, but it wasn't that terrible. Microsoft announced earnings of $4.14 a share versus the estimates, which were $3.91. Revenues were $81.27 billion. The estimates were $80.31 billion. And their CEO announced, quote, "We are only at the beginning phases of AI diffusion, and already Microsoft has built an AI business that is larger than some of our biggest franchises. We are pushing the frontier across our entire AI stack to drive new value for our customers and our partners." Microsoft Cloud revenue crossed $50 billion this quarter, reflecting the strong demand for our portfolio of services. We exceeded expectations across revenue, operating income, and earnings per share, end quote. So I wonder with that statement in there, if he was surprised to see the stock gap down more than 10%, which resulted in the stock now being down 12% for this calendar year. And it it has erased the entirety of the gains that the stock saw in 2025. They guided the current quarter revenues to be right at the current estimates, along with their operating expenses. But the broad summary on FactSet was that their cloud business, Azure, they called it lackluster, despite being ahead of the expectations and the guidance there, being ahead of the estimates for the coming quarter. And there's this general concern about their spending as this AI race continues. It's how much are they going to spend on AI versus how much cash are they going to reap from their cloud business while that goes on. Oracle, another big AI spender, they've suffered some pretty bad consequences in the stock recently. They've lost over half their value since September. But hopefully the difference here is that Microsoft actually has far deeper pockets full of cash. In response to the results, an analyst at Wedbush said that this is a buying opportunity, while he did lower their price target to $575 a share, saying that the street was looking for lower spending along with faster monetization, but the opposite unfolded. And, this might be a good argument for the folks over at OpenAI to hold off on any plans for going public anytime soon until these types of valuation bloodbaths play out. Goldman Sachs had similar conclusions about Microsoft, kept it at a buy. They kept a $600 price target on the stock, saying that the stock is reacting to CapEx being 9% higher than what the street expected, and that while Azure is funding the spending, the increase from Azure didn't match the increase in spending, so that the balance is off. But Goldman went on to conclude that they like the prioritization on Microsoft's AI spending and that the spending priorities will, quote, drive more strategic AI positioning across multiple layers of the technology stack and better returns over the medium term, end quote. And that's the argument that still has many years to play out, with Microsoft perhaps ahead of the pack here in seeing actual revenue, actual monetization earlier on in the game. But the spending is going to continue, and the volatility will keep helping and hurting these hyperscalers while feeding the near-term revenue and earnings growth for those that are actually selling the chips and the equipment into those investments. So the debate will rage on about the rewards for AI, but it's really shouldn't be concluded to be a debate about those that are selling the stuff. And one of those, and another one that we do own, is GE Vernova. This is one of the elements that General Electric spun off a few years ago, as this is the business that's focused on selling basically the turbines and the equipment that are used to build the generation of electricity facilities using natural gas, wind, and also nuclear power. And they also saw a pretty volatile day on Thursday after they announced their earnings Wednesday night. Not as much as Microsoft, but the stock was initially indicated to gap down a good amount. Not as dramatically, but gap lower, only then to see the stock rally as the conference call wound on. Whatever triggered it, stock traded up into the green, and then later on in the afternoon trended lower, a bit lower into the red. But that might just be because the broader markets were giving up their gains on the day as the day wound on. The report itself was, I'll say, kind of messy. Literally said on FactSet that GEV, the symbol, announced earnings of $13.39 a share, which, quote, is unclear if reported EPS is comparable to consensus estimates of $2.93 a share, because that would be quite an incredible beat on expectations. The revenues were $10.96 billion for the quarter versus estimates of $10.21. But in this case, I guess EBITDA is a better read here, which was $1.16 billion, lower than the estimates of $1.29 billion. A big standout for them was that their orders for the period were $22.2 billion. That's a 65% organic growth rate. And their backlog of business grew by $15 billion. And for more clarity, Vernova offered full-year guidance for this year of $5 to $5.5 billion in free cash flow. And that was versus their previous guidance, which was $4.5 to $5 billion. And it's the right trend, but they're going to keep needing to keep doing more of that, because while I think they're absolutely in the sweet spot as far as having this kind of enviable demand for their products, that's not a secret. And the company currently trades at just under about a $200 billion valuation. So if they're going to generate $5 billion in free cash flow, you got a low single-digit free cash flow yield there. Their CEO did, though, promise more of this, pointing towards their total backlog right now of $150 billion in business, along with improving margins. And he said that, quote, our platform of advanced solutions is well-positioned to serve the growing long-cycle electric power market, and there is substantial opportunity to deliver even better performance ahead, end quote. Long cycle is the key point for me there, the key phrase there. As I was in a conversation with someone representing one of the companies that is a buyer of this equipment and a company that's building all these data centers, and they made a point of saying that they don't break ground on one of these projects until the site is both power ready and also that they have typically a 15-year lease in place from one or more of these hyperscalers who, again, may or may not see huge rewards from this huge investment in AI, but the expectation is that companies like Microsoft will be able to keep paying their contractual lease obligations. At William Blair, their analyst said that GEV remains one of their top picks for the year. They said that a worse than expected result in the wind portion of the business wasn't surprising given the current policy backdrop. But as a side note there, some wind projects had a major legal victory in that regard this week. But that guy at Blair went on to point out that GEV's turbine business is already completely sold out through 2028, and that management expects them to sell out their current capacity through 2029 as well as 2030 by the end of this year. So while the valuation on the stock is far from cheap, you got to like the visibility into future sources of revenue that this provides. I'm sure the people in New York and Florida where all these turbines are built appreciate that. One last bit, at Oppenheimer, their analyst pointed to the closing on Vernova's purchase of Prolec in the first quarter this year as having potential upside for the company and their results this year. Prolec's a manufacturer of transformers, and Vernova actually does more than just selling into the AI tech stacks. In fact, the country's the country's in pretty bad need of improving existing electrical distribution, in addition to meeting the needs of all this additional supply. So this bolt-on acquisition continues to position them well within what Oppenheimer called a mission-critical technology provider, leveraged to the growth of the power infrastructure. Both these names, I think, generally appear well-positioned, with Microsoft seeing such a huge step back, it's tempting us to looking to adding to it. And GE Vernova, they might be a couple of turns short of being a huge buying opportunity on valuation, but undeniably, I think, very well positioned in this economy. All right, that's it for me this week. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.